Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. I'm your host, Lance Roberts. And of course, as so go the markets, so goes how the rest of this year may look. It's been a tough year to the markets, really, ever since the beginning of this year. We rang in all-time highs back in January. And since then, it's been a really tough road for investors. And here's the interesting thing about this is that I'm writing an article about this now that I'll have out here on the website very soon. But talking about there's a difference between the way that we look at financial markets and the way that the Federal Reserve looks at financial markets. And this is going to have a lot to do with how the rest of this year plays out, and something that we're going to talk about more over the course of the next few months as the Fed begins, more aggressive rate hikes. But importantly, we need to keep in perspective also about where we've come from and how we've gotten to where we are. And a lot of this has to do with a massive amount of monetary liquidity that was poured into the markets back in 2020, 2021 that created the inflation that we're looking at today, because you had the shutdown of the economy, you had all this liquidity, everybody went out and bought stuff, that created the inflation. And the mistake that a lot of people made and economists made was assuming that the organic growth, or I should say rather the economic growth that was in the economy at that time was organic. And that was just occurring because, the market's reopening and the economy's getting back to work, so all this economic growth is just part of this natural function, this natural process. But it wasn't. It was all fueled by all this liquidity that was dumped into the market. So here we are today. Now, markets have had a very tough start since the beginning of the year. In fact, it's been the roughest start to a financial market since like the 1920s during the Depression. So it's been a very long time since we've had such a very tough road to start an investment year in a long time. And really in most years that investors have never seen a year like this. And so it's been very tough, been very challenging to try to manage portfolios here. And this is, again, as we've talked about before, this is where investors make a lot of their mistakes. They tend to panic sell lows. They tend to start doing things that are don't really bode well for their portfolios overall. So this is the time that it's important that we go back and look at investment strategy and go back to our discipline. And this is the whole value that great investors, and we talk a lot about the great investors throughout history. We talk about Paul Tudor Jones. We talk about Warren Buffett. We talk about these guys that have made a name for themselves, Howard Marks and others that have made a name for themselves by being really great investors in the financial markets. And they bring a lot of experience and value to the table, but we tend to ignore them for what they actually did. We revere them for being so great at it, but then we don't follow their rules, right? We don't follow their processes. And as investors, this is where we make a lot of our mistakes. And I was talking to somebody the other day about investment strategy and investment discipline. And and they asked me the question, well, what is an investment strategy? I go, well, how are you investing if you don't have a strategy? And this is the biggest problem that investors have right now. If you don't have an investment strategy that you follow, right, whether it's a fundamental strategy or a technical strategy, whatever it is, and it's got to be something that's well thought out and well cemented so that you're not deviating from it on a consistent basis. But, if you don't have that foundation to work from, then you have nothing to go back to when you get in times of trouble. Look, when markets are rising like they were in 2020, 2021, that's easy, right? You just throw money into the markets. I was getting Facebook posts from people going, this is so easy. Why am I working? I just throw money into the markets and it makes me more money than I get at my job. That's what we always see in kind of bubblish markets, right? We saw it back in 1999. We saw it in 2007. Same exact type of commentary being made by individuals saying, investing so easy, a monkey can do it. Well, then the other side of that bubble comes, right? And this is where things get a lot more difficult. Well, if you're just throwing money into the markets when markets are rising, that's great. but you don't have an investment strategy to fall back on when the markets begin to become more challenging, like they have been in 2022. So this is why it's important to step back before you make those decisions about, I just need to sell stuff and get out of the markets or whatever it is, or I'm going to go chase whatever's going up. If you don't have an investment strategy and a discipline that you can rely on and build your strategy off of and build your portfolio off of, you're going to continue to run into problems of buying stuff too high, selling stuff too low. And look, right now, a lot of people are running into the commodities market. So I want to be long commodities because there's inflation and there's all this other stuff that's going on. That's fine for right now, but that's going to change. We've already probably seen the peak of inflation. And as we get further into this year, we're going to see even weaker rates of inflation, and that could potentially, and if we do get into a recession, look, and let's just, for right now, I'm not saying there's a recession coming, but there's certainly some good economic indicators out there that suggest there's a real slowing going on in the economy. So if we do get into recession later this year, that's going to bring all these commodity prices back down. Well, here you are trapped again. Now you chased what was going up last year and this year, and now you're on the wrong side of the trade again. And this is what happens to most investors over time because they tend to chase what's hot. And by the time they get into it, by the time they realize that that's the hot sector to be in, it's already at the end of that cycle, whatever that cycle is. And commodities run a very, very short and volatile investment cycle. They run up very sharply and they collapse just as quickly. And that's just the nature of commodities in general. And this is why it's so hard for farmers and agriculture and people like that to make money, because prices move all over the place. This is why they go out and they hedge their product and hedge their production, because again, prices are so volatile in the commodities markets, it's not easy, to just make money. And this is one thing to kind of focus back on. Just be careful that you're not just chasing trends. And if you don't have an investment strategy of whatever it is, right? I have a fundamental strategy based on price to sales, price to earnings, cash flow, free cash flow, whatever it is, or I have a technical discipline that I follow for, buying stocks when they're oversold, selling them when they're overbought. If you don't have that investment discipline, or a strategy, get one. And if you don't know how to get one, maybe consider hiring an advisor that does, because that's going to keep you out of trouble longer term. It's going to help navigate markets. Now, does that mean that you're never going to lose? Just because you have an investment strategy, does that mean you're never going to lose money in the markets? Absolutely not. But the goal is to not be down as much as the market when the markets are down. And that means making money when markets are up. And you're not going to beat the markets every year, right? When markets are up, you're not going to make as much money as the market does. When the markets are down, you should be doing better than the markets when the markets are down. Over time, you're going to create that average rate of growth that you need to reach your financial goals. And ultimately, isn't that why we invest to begin with? Do we really invest just to speculate and try to beat some random benchmark index? Or are we investing to try to grow our money at a rate to meet our financial goals for retirement? That's really the question you need to ask, and think about how we get there from here. Now, we've got a lot to talk about this morning, so stick around. More of the Real Investment Show is coming up right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.